Hi there, good morning. You're watching Power Breakfast on CNBC TV 18. I'm Manglam Malu. With me is Anisha Jain. Anisha, it's been a good morning.
Oh, yes.
The Dow up around 700 points. The Asian market's doing fairly well. And the SGX Nifty, we saw signs of a bounce on Friday's trading session. We recovered almost 120 points from the lows. And then now we have the SGX Nifty, which is indicating that we add another 100 points to that.
Oh, well, yes, it looks like the day is going to belong to the bulls, given the fact the events that took place in US, but a tad bit of niggling worry, not to be the party pooper, but the fact that the crude is racing towards $58 per barrel is a tad bit of overhang, but I don't think today we would care too much about that. But first, let's run you through the top headlines at this hour. Wall Street stages a major rally to close out the week with gains after a robust jobs report. Also bolstering sentiment were remarks by Federal Reserve Chair Jerome Powell.
Jerome Powell says that the US economy is in fine fettle as the jobs data indicate, but Fed is ready to look at a balance sheet reduction and rate hikes if needed.
And the partial US government shutdown enters its third week, with neither side backing down on funding for the border wall. President Trump now holding out what he says is a new compromise. He said, and I quote, that I will make a steel barrier.
Asian markets start the week on a positive note ahead of the US-China trade talks in Beijing, which start today. The SGX Nifty indicates a strong start for our markets. All right, so let's take that point forward. The Asian markets, they're looking very, very strong. And that's primarily because investor sentiment picked up slightly ahead of a round of trade negotiations between the United States and China in Beijing, which is currently underway for the next 2 days, 7th and 8th of January. However, you know, the sentiment, the positive sentiment was set through on Friday's trading session itself, where we saw a near 700-point gain on the Dow on account of various reasons: strong jobs report, commentary coming in from Fed Chair Jerome Powell, and general oversold conditions in that index. So the Nikkei trading at around 3.1%. Most of the gains led higher by Toyota, and that's primarily because the dollar yen, which is currently at 108.5. Remember, sometime last week it was sub 106, so some weakness seen there, though it is still stronger than earlier levels of 111 to 112. But the recent weakness is a positive sentiment booster as far as the exporters are concerned. And then you take a look at the Korean markets. They're doing fairly well as well. 1.5% gains out there. Most of the gains led by SK Hynix, as well as another couple of automakers, and POSCO, the steel maker. Straits and Taiwanese index, both of them higher by about 1.5%. The SGX Nifty, that one should come up for you. The key point for our markets is that the SGX Nifty indicates a 105-point gain, very, very close to the 100-day moving average of 10,886. We have seen the markets retrace from those levels earlier towards the lower end of the zone around 10,500. Let's see what happens. But as of now, 10,900 is where the start is. That is indicated by SGX Nifty. Higher crude. Let's see what happens.
Okay, that was about Asia, everything in the green, and that is because there were some positive developments in the US. Now, the Dow jumped 700 points, while the Nasdaq and the S&P 500 also ended the day with gains of over 4% and 3% each. Now, this after the US Labor Department released the jobs data for the month of December, and as per the data, the economy added 312,000 jobs in the month of December, and that is against the expectation of just 176,000 jobs. Now, another important development was the comments actually coming in from the US Federal Reserve Jerome Powell. He said that the central bank will be patient in its approach to monetary policy. He added that there is no preset path for raising rates or adjusting the balance sheet.
All right, and let's take the jobs growth point forward. The job growth surges by 3,12,000 in December. This again, expectations of worth just about 1,76,000 job addition. And in addition to the big job gains, wages, they jumped 3.2% also from a year ago. So what does this mean for the US economy? What does this data imply? Steve Leisman is here with more.
Economists are kind of reaching for metaphors and dusting off the adjectives here to describe this jobs report. Exceptional is a number a word I keep hearing. Superb is another one. 312,000 jobs created. Let's look at the data and show you that there's really strength throughout the report here. Look at the revisions, October, November, up by 58,000. Average hourly wage is 0.4%. That's a strong number, 3.2 year over year. Unemployment rate ticking up because a lot of people came into the workforce, didn't necessarily find jobs. Labor force participation rate ticking up. We're bringing more people into the workforce. And where the jobs are is also interesting. You look at it in terms of education, health services. That's a big number. Maybe a little bit of noise in that number there. But leisure hospitality, we had a report that they were jammed down at Disney and Universal over the holidays. 55,000 workers added. Construction doing well. Manufacturing doing well. Even retail, which, by the way, expects massive seasonal hiring. Also mentioned the impact here, what it means for the Fed. That's what economists are saying over at Evercore ISI. Krishna Guha writes, today's very strong U.S. employment report with 312,000 payroll gains in December and strength in wages lends much needed support to the Fed view that the U.S. domestic economy ended the year in generally solid shape in spite of turmoil in financial markets and weakening global growth. Over at Oxford, they write, the very strong labor market picture support our expectation that the Fed will keep a tightening bias in 2019 and hike rates twice next year. Now, we did interview Loretta Mester, the Cleveland Fed president, just before the number came out, and she was sort of on the fence. She could go either way, depending upon how the data came out. Here's what she said.
I don't feel an urgency to increase rates from where we are now because I see an impending inflation problem. I don't see that in the data. I do think that, we have to take into account that financial market conditions have tightened, and we want to build that into our forecast. I do think policy is neither, ahead of the curve or behind the curve. I think we're in a good spot.
Well, the other big headline over the weekend was the fact that Jerome Powell, the chairman of the U.S. Federal Reserve, has pledged that the central bank will be watching how the economy performs this year and will adjust policy should growth slow unexpectedly. Now, Powell, along with his immediate predecessors, Janet Yellen and Ben Bernanke, was speaking at the American Economic Association's annual meeting in Atlanta. Powell said that the U.S. economy was in fine fettle, as indicated by the jobs data, but the Fed might reconsider further rate hikes if growth slows down. That's not all. Powell also indicated that the Fed would not hesitate to tweak their balance sheet reduction plans if it was causing problems. And lastly, Powell said that he would not resign from his post even if President Donald Trump asked him to.
Financial markets have been sending different signals of concern about downside risks, about slowing global growth, particularly related to China, about ongoing trade negotiations, about what maybe let's call general policy uncertainty coming out of Washington, and among other factors. So, you do have this difference between, on the one hand, strong data and some tension between financial markets that are signaling concern and downside risks. And the question is, with those contrasting sets of factors, how should we think about the outlook and how should we think about monetary policy going forward? Now, when we get conflicting signals, as is not infrequently the case, policy is very much about risk management. And I'll offer a couple of thoughts on that to wrap up. First, as always, there is no preset path for policy. And particularly with the muted inflation readings that we've seen coming in, we will be patient as we watch to see how the economy evolves. But we're always prepared to shift the stance of policy and to shift it significantly if necessary in order to promote our statutory goals of maximum employment and stable prices. And I'd actually like to point to a recent example when the committee did just that in early 2016. And I mentioned this in this December press conference in passing. As many of you will recall, in December 2015, when we lifted off from the zero lower bound, the median FOMC participant expected 4 rate increases for 2016. But very early in the year, in 2016, financial conditions tightened quite sharply, and under Janet's leadership, the committee nimbly, and I would say flexibly, adjusted our expected rate path. We did eventually raise rates a full year later in December 2016. Meanwhile, the economy weathered a soft patch in the first half of 2016 and then got back on track. and gradual policy normalization resumed. Now, no one knows whether this year will be like 2016, but what I do know is that we will be prepared to adjust policy quickly and flexibly, and to use all of our tools to support the economy, should that be appropriate, to keep the expansion on track, to keep the labor market strong, and to keep inflation near 2%. So let me talk about the balance sheet. Some years ago, we decided that rate policy was going to be the active policy tool, and that the balance sheet would be allowed to shrink gradually and predictably in the background. And it was supposed to be about as interesting as watching paint dry, in Janet's famous locution. So, and that division of labor has served us well, and we think has served the economy well. And so we also said at the very beginning, I think in our original, certainly the first policy normalization plans that I was involved in 2014, we said that we would be prepared to adjust our normalization plans as appropriate to achieve our goals. So if we ever came to the conclusion that any aspect of our normalization plans was somehow interfering with our achievement of our statutory goals, we wouldn't hesitate to change it.
Have you received anything direct from the White House about unhappiness with the path of rates or the discussion of any change in your job?
No, I've not. I have not. I have no news for you on that.
There's also been discussion of a face-to-face meeting between you and the president. If invited, would you accept that kind of invitation if it were made?
So again, I have no news on that. Nothing's been scheduled. I would say that meetings between presidents and Fed chairs do happen, and they've happened. I think I can't think of any Fed chairs who didn't eventually meet with the president. But again, nothing has been scheduled, and I don't really have anything to report on that.
If the president asked you to resign, would you do it?
No.
All right, categorically saying no if the president asks him to resign. So with that, let's hear out what David Kelly of Morgan Funds and Catherine Mann of Citi had to say on the strong jobs numbers, as well as the Fed rate trajectory and the commentary coming in from Jerome Powell.
I think the Fed may actually revise what they thought even from their December 18th meeting, because remember, what's happened since then is we've seen oil prices fall further. It now looks like inflation is going to stay well below their 2% target throughout 2019. Also, this decline in market values, I mean, one of the big problems they had is asset bubbles. Well, we've done a lot to reduce asset bubbles in the last 6 weeks. So I think the Fed may do at most one rate hike this year. I think that it would be justified for them to be more dovish based on how much the market has fallen because of market volatility, because of lower inflation. But the other thing, there's been a lot of talk about momentum investing in the last few weeks. I think what we're seeing here is momentum economics.
Apple is very much engaged with China, very much engaged with financial engineering as part of their overall strategy. And so you have these two different economies, one domestically oriented, not financially market engaged. That's very strong. We've seen that in the data. And then you have another part of the economy that is more oriented towards financial markets, more oriented towards the external economies. And those businesses are the ones that are suffering a little bit with this equity market meltdown. So we'll see how those two pieces of the economy come together in 2019. And I think what we're looking at is the momentum coming from the job market and from consumption and from investment in order to deal with very tight labor markets, that will power the economy longer than many people on the financial markets think.
Well, meanwhile, President Donald Trump has threatened that the partial shutdown of the American government will go on for as long as it takes to get funding for his proposed border wall. Now, the U.S. president was speaking to the press after his 2-hour meeting with the Democrats. Now, remember, the Democrats described the negotiation as contentious and showed little optimism about ending a partial government shutdown. Ilan Mui reports on the same.
It was yet another wide-ranging marathon news conference by President Trump. You got a sense there of how interconnected all of these issues are for him. Border security, the government funding fight, immigration, trade, all of them sort of wrapped up together in this one news conference. I think one of the most important things is what you highlighted, is that he confirmed that this shutdown could last for years. He's prepared for that to take place. Here's what he said.
You said in the meeting, this is him quoting you, I just want to check, that the shutdown could go on for months or even a year or longer. Did you say that? And is that your?
I did.
Is that your assessment of where we are?
That. Absolutely, I said that. I don't think it will, but I am prepared, and I think I can speak for Republicans in the House and Republicans in the Senate. They feel very strongly about having a safe country, having a border that makes sense.
Guys, there has been so much back and forth in this shutdown fight that I want to point out that the steel slats that the president spoke about during that news conference, those would actually be allowed under the language that was originally passed by the Senate, under the language that was passed by the House. The language in the text of the bills prohibits concrete barriers. The president now talking about steel slats, steel barriers as stronger than concrete ones. And that's really important because I think that what you're talking about here now is not just what does the structure look like, but this highlights the fact that this is a fundamental ideological disagreement between Republicans, Trump Republicans, and between Democrats. And because this is now a philosophical fight, that is why both sides are so hunkered down, and that is why it has been so difficult for them to reach any type of resolution, guys.
All right, so a resolution on that will be awaited. More importantly, when the U.S. government starts again after this shutdown is something that the street will be watching out for. Let's move across the Atlantic then. The European markets, they extended their gains in Friday's trading session, and this on account of following the stronger than expected non-farm payrolls data that came out of the U.S. In terms of data, the IHS Markit's Eurozone Composite final PMI, that fell to 51.1 in December. This compares with 52.7% in the previous month. The Eurozone December inflation rate, meanwhile, fell steeper than was expected to 1.6%, and this compares with November's 1.9%. It was the basic resources, metal stocks that have more exposure to China or more exposure to trade dynamics with US and China that did fairly well in the European region, and that was primarily on account of the news that the US and China are holding trade talks on Jan 7th as well as 8th. Across the emerging markets too, we saw some gains.
Okay, so green across emerging markets, Europe, US as well as Asia. But in the currency market, the dollar has actually dipped, giving up all the gains logged after a robust US jobs report following comments from Federal Reserve Chairman Jerome Powell that the US Central Bank will be sensitive to the downside risk that the market is pricing in. The dollar index currently sitting at 96.11. Remember, last week we had seen levels of 96.8 as well on the dollar index.
In the world of commodities, crude oil prices rise ahead of the US-China trade talks in Beijing, but gains are capped after United States reported a sharp build-up in refined product inventories, Brent just under $58 per barrel.
Well, it's time for a quick break on the show. Up next, we'll get you all the cues and news you need to know for trade this Monday morning. Stay tuned for that.